People like to complain about the U.S. tax code as if it's some mathematical puzzle that got a few lines wrong. That's not the problem. The numbers are the easy part. The hard part is the people. Most folks don't understand how the tax system actually changes. They imagine a committee of wise old economists sitting down with sharpened pencils, calmly designing something sensible. What a lovely fantasy. The truth is far less poetic. To fix the tax code, you need 218 members of the House, 51 senators, and a president who's willing to sign the bill. Try getting all those people to agree on anything more complicated than lunch. You'll quickly discover why the tax code looks like a jigsaw puzzle thrown into a blender. And then you have the lobbyists. Once a special little revision gets slipped into the code, usually written by someone representing an industry with a lot of money and an even larger ego, it becomes permanent. You can't dig it out. Not with logic, not with patriotism, not with dynamite. It's lodged in the system the same way barnacles cling to a ship, except barnacles don't hire lawyers. People keep waiting for a grand rewrite of the tax code. They imagine some heroic senator standing up one day saying, "Enough. We will simplify this mess." Well, good luck. Every line in that tax book is someone's sacred cow. You remove one deduction, and 10 angry interest groups show up with pitchforks. That's why nothing changes. So when people ask, "Charlie, why is the U.S. tax system broken?" I tell them, because it was designed by human beings, and not the best ones. Look at how politics works. Everyone wants to spend more, tax less, and somehow balance the budget. It's magical thinking, and the tax code becomes the dumping ground for every unrealistic promise made on a campaign stage. Warren likes to say that deciding a tax system is simple. You choose how much the country should spend, then decide who pays for it. But try explaining that to politicians. They behave as if money appears through spontaneous generation. A miracle, straight from the heavens, timed conveniently around election season. And so we end up with a tax code that tries to please everyone and ends up pleasing no one except maybe the accountants who have never been busier. The code isn't broken because it's complicated. It's complicated because it's broken. We've created a structure full of hidden tunnels and secret compartments. You could put 10 Nobel Prize winners in a room, and they still couldn't explain half of it without arguing. I've lived almost a century, and I still find new lines in the tax code that look like they were written at 3 a.m. by a man suffering from a caffeine overdose. Take corporate taxes. Business leaders love to moan about how high they are. But corporate taxes, as a percentage of GDP, have fallen from 4% to 2% over the last several decades. So tell me again how oppressive the system is. It's amazing how often rich people complain while drowning in cash. I've never found it persuasive. Meanwhile, payroll taxes, the taxes on ordinary working people, have gone up. Funny how that happens. The people with the money write the rules. Then they pretend the rules treat everyone equally. That's one of the great jokes of American public policy. And yet, and this is the painful part, the system could actually be fixed. We have smart people in Congress, not many, but a few. They know what needs to be done. But politics requires compromise, and compromise requires humility. And humility is in very short supply in Washington. The best chance we ever have of cleaning up the tax code is if the negotiations happen in private. That's right, the opposite of transparency, because once the cameras turn on, every politician performs. They pretend to be heroes defending the people while actually defending the donors. It becomes theater, bad theater. If the Constitutional Convention had been televised, the United States would still be arguing about the shape of the table. So when I say the tax system is broken because of people, I mean exactly that. Human behavior ruins everything. Throw in ego, ambition, fear, and a desire to be reelected, and you have the perfect recipe for dysfunction. The tragedy is that Americans keep asking for a fair, simple, rational tax system, and they won't get one. Not because it's impossible, but because too many people profit from the current chaos. The complexity is not a bug. It's a feature carefully engineered by generations of clever attorneys and frightened politicians. The tax system didn't break itself. We broke it. And unless we magically produce a Congress filled with philosopher kings, which I wouldn't bet on, it's going to stay broken. If you ever want to understand why the U.S. tax code looks the way it does, just remember one simple Munger rule. When you mix money, politics, and human nature, you don't get efficiency. You get exactly what we have. Let me tell you something about corporate America. They have refined the art of complaining into a competitive sport. If there were an Olympics for whining about taxes, half the Fortune 500 would be medalists. Every year, you hear the same chorus. Corporate taxes are killing us. We're being strangled. We can't compete. Well, let's look at the facts, something I recommend more often than people actually do. 40 years ago, corporate taxes were around 4% of GDP. Today, closer to 2%. That's not a minor reduction. That's cutting the thing in half. If your weight dropped 50%, your doctor would faint from happiness. Yet, corporations call this a crisis. It's nonsense. Corporate profits, meanwhile, have climbed to record highs as a share of GDP. So what exactly is strangling them? Certainly not the tax man. Maybe it's the psychological trauma of not being able to shift all their income to Bermuda quickly enough. And yet the complaining continues. A typical CEO steps on stage, adjusts his $12,000 suit, and tells you with a straight face that corporate America is suffering under unbearable tax oppression. The audience nods. Analysts nod. Journalists nod. It's amazing how many heads will nod in unison when a rich person complains. Let me give you the simplest comparison possible. Retirees in America put their savings into bank certificates of deposit. They get, if they're lucky, 0.5% interest. Meanwhile, major corporations earn 15% or more on tangible equity, 15% versus 0.5%. And somehow the corporations are the ones being oppressed. That's the kind of thinking that makes me want to take a long nap. People say business is being crippled by taxes. But if a business earning 15% returns is crippled, then we should all hope to become paraplegics as soon as possible. The truth is this: corporations in America are doing extraordinarily well, better than any time in modern history, and they're paying a smaller share of the nation's tax burden than they did in the past. But complaining is part of the game. If you don't complain loudly, someone else gets a better loophole than you do. So you end up with billion-dollar companies acting like starving artists begging for coins. It would be funny if it weren't so predictable. And here's another irony. The people who actually get hammered by taxes aren't the corporations. They're the employees. Payroll taxes, the taxes workers pay out of every paycheck, have risen dramatically. They've become one of the largest sources of federal revenue. That's the dirty little secret. You shift the burden from the powerful to the powerless, and you call it economic policy. This is why I say the system isn't just broken, it's distorted. The people shouting the loudest are usually the ones with the least to complain about. And the people staying quiet, the workers who can't hide their income in the Caymans, are the ones footing the bill. Now, I'm not against corporations making money. I've spent my whole life supporting companies that make money hand over fist. But I do prefer honesty over theatrics. And the theatrics surrounding corporate taxation are among the most absurd in American life. Here's another point. When CEOs say taxes hurt competitiveness, what they mean is they want everyone else to pay more while they pay less. That's the actual argument. Dress it up however you like. The meaning doesn't change. Look at Berkshire Hathaway. Warren and I operated for years when corporate tax rates were 48% and even 52%. We didn't whine about it. We just ran our businesses intelligently. And guess what? America thrived. Companies thrived. The economy grew. So when modern CEOs panic over tax rates that are historically low, forgive me if I don't take their anxiety seriously. The country has been here before, and it survived. Corporate America is not being crushed. It's being coddled. And like any overindulged child, it still demands more. Let me add something else. We're in a bizarre environment where equity holders, the shareholders, are earning remarkable returns. Debt holders, the people who trusted the banks and put money in CDs, are earning crumbs. And yet, corporations keep arguing they need lower taxes to reward investors. Reward them for what? Being lucky enough to own assets during one of the greatest bull markets in history? The logic is astonishing. It's like a man who wins the lottery and then demands his city waive his parking tickets because he's had a tough year. If you earn 15% returns in a world where retirees earn 0, 5%, you are not oppressed. You are winning handsomely. So let's stop pretending the corporate tax system is some unbearable burden on heroic companies. It's not. It's one of the greatest deals corporate America has ever enjoyed. And the fact that they still complain proves something I've believed my entire life. The easiest person to fool is the one who thinks he deserves more. Corporations don't need lower taxes. They need fewer excuses. And Americans need the honesty to admit that the people screaming about oppression are usually the ones standing on top of the mountain. People love to talk about the $2.1 trillion trapped overseas, as if the money is sitting in a dungeon somewhere, guarded by dragons, waiting for Congress to rescue it. That's not what's happening. The money isn't trapped. It's parked by choice. Corporations can bring that money home tomorrow morning. All they have to do is pay U.S. taxes on it. That's the whole mystery. There's no secret code, no hidden switch, just a tax bill they don't want to pay. And somehow this has turned into a national drama. Every year, CEOs line up to say, we'd love to invest in the United States, but our money is stuck overseas. It's not stuck. It's avoiding. Avoidance is a very old human instinct. Let me translate what these executives really mean. We want the benefits of being American companies, but we'd like a discount on the responsibilities. It's a clever strategy, and it works because people keep falling for it. The truth is simple. U.S. corporate tax rates are higher than in many countries. So multinational companies shift income to places where taxes are lower or non-existent. Ireland, the Netherlands, Bermuda, Cayman Islands. You can find more economic activity on those islands' financial statements than you can find in their actual geography. And now we're supposed to feel sorry for them because they have to pay taxes when bringing the money home? Warren put it perfectly. If they want to bring it back, they can. They just don't want to pay the tax. That's not a tragedy. That's a choice. But here's the real problem. The U.S. tax system encourages this behavior. It rewards it. It practically begs companies to keep money offshore. This is what happens when you design a system with bad incentives. And if I've learned anything in my life, it's this. When you create a bad incentive, people will follow it faithfully, even if it's terrible for the country, even if it's terrible for long-term productivity, even if it makes no moral or economic sense. Human nature is remarkably consistent. America wants companies to invest at home, but taxes encourage them to invest abroad. It's the kind of contradiction only a bureaucracy could produce. Think about it. A company earns money in Europe. They keep it in Europe because the tax bill to bring it home is too high. The U.S. economy gets nothing. Workers get nothing. Innovation gets nothing. But some small bank in Luxembourg is thrilled. And Wall Street analysts applaud the tax-efficient strategy. Meanwhile, politicians go on television and pretend they're shocked that corporations refuse to voluntarily increase their tax bill. That level of shock is usually accompanied by bad acting. Let me give you a rule of thumb. If your tax system encourages companies to move their money as far away from your country as possible, your tax system is stupid. American businesses are not stupid. They respond to incentives. So they keep money offshore, avoid taxes, and then lobby Washington to lower the rate. It's a beautiful cycle for them. The tragedy is that this isn't even illegal. It's entirely logical under the current rules. That's what makes it even more absurd. You want companies to invest in America, lower the incentive to avoid taxes. It's simple arithmetic, but simple arithmetic is strangely controversial in Washington. And here's the funniest part. The same CEOs who refuse to bring money home because the taxes are too high will turn around and pay their investment bankers enormous fees for some pointless merger that destroys half their value. They're thrifty with the government, reckless with shareholders. It's an interesting combination. But the offshore cash story reveals something deeper. It's not just about money, it's about moral hazard. The system teaches executives that they can benefit by shifting obligations onto everyone else. And that kind of thinking doesn't stay confined to taxes. Pretty soon, you start seeing financial engineering disguised as business strategy. Companies inflate earnings. They manipulate timing. They stuff channels. They overpromise to Wall Street. And when the expectations can't be met, they bend the numbers until they do. It all comes from the same root. Bad incentives produce bad behavior. The offshore tax rules create one of the worst incentives of all the belief that a company can avoid responsibility without consequence. And once that mindset spreads, it becomes cultural. At Berkshire, we've always avoided incentives that encourage misbehavior. We've seen too many examples where a single bad incentive corrupts an entire organization. Good people start doing stupid things because the system tells them stupidity is rewarded. It's a slow, invisible rot. And that is what the U.S. tax system is suffering from right now. A slow, invisible rot. Not because people are evil, but because they are human. And humans respond to incentives more reliably than they respond to ethics. So when you hear about money stuck overseas, understand the real story. The money isn't stuck. The system is stuck. The behavior is stuck. The political will is stuck. And nothing will change until the incentives change. If you want corporations to bring their money home, give them a reason. If you want them to invest in America, stop encouraging them to invest everywhere else. And if you want a rational tax system, stop designing one based on illusions about human nature. Because until that happens, the $2.1 trillion will stay exactly where it is. Not trapped, not frozen, just sitting offshore, waiting for America to stop being stupid. Let's talk about state taxes for a moment specifically. The kind of tax policy so foolish that even a patient man starts looking for the exit. California is a wonderful place, beautiful weather, smart people, terrible tax policy. If you want a perfect case study on how to drive productive citizens out of your state, California has written the instruction manual, and it's not a short manual. It reads like something drafted by a committee that has never met an economist or a calculator. I live in California. I've paid California taxes for decades, and let me tell you, the state has managed to design a system where long-term capital gains, the very thing that rewards investment and innovation, are taxed at roughly 13.3%. And here's the kicker. It's non-deductible for federal tax purposes. Imagine charging people a high tax and then telling them they can't deduct it anywhere. That's not aggressive. That's hostile. Meanwhile, states like Florida and Hawaii have figured out something quite obvious. Rich people are useful. They spend money. They fund hospitals. They keep restaurants open. They pay enormous property taxes. And contrary to popular imagination, they do not commit many crimes. So, naturally, California treats them like an invasive species. The logic is astounding. Let's impose the highest tax rates in the country, remove reasonable deductions, and then act confused when successful people decide they'd rather not burn half their income to support a government that can't pave its own roads. This is not a mystery. This is gravity. You cannot push people harder and harder and then act incredulous when they move to places that don't push them at all. Florida figured this out. They said, we don't tax your income. Please come enjoy the sunshine. California said, we tax everything except your enthusiasm. Guess which strategy wins? But here's the truly ridiculous part. California politicians are shocked, absolutely shocked, when wealthy residents leave. It's like watching someone slap a man in the face and then ask why he's stepping backward. If you make it painful to stay, people leave. This is not advanced psychology. And yet, every year, California behaves as though it has discovered teleportation. Why are the rich disappearing? Where did they go? How could this be happening? Well, let me help. They went to states that want them. A rational society understands incentives. It does not punish success. It does not treat wealth creation as a public nuisance. It does not pretend that the people paying most of the bills are somehow freeloading. But many states operate in a fantasy. They believe capital is immobile, like a house or a tree. They think they can tax it however they wish, and it will obediently remain there forever. This is unbelievably naive. Capital has wings. It flies to hospitable environments, the same way birds migrate south in the winter. Hawaii and Florida don't pretend to be moral heroes about it. They simply understand that wealth is a net good. It raises the economic temperature of everything around it. California, meanwhile, acts like the presence of rich people is a moral failing that must be corrected through taxation. It's a very strange philosophy and a very expensive one. And here's the quiet truth no one likes to say out loud. When productive people leave, the people who remain must shoulder a greater burden. A shrinking tax base doesn't magically generate the same revenue. It collapses. Then services collapse. Then politicians raise taxes again to fix the collapse. And the cycle gets even worse. This is how decline begins. Not with violence, not with catastrophe, but with steady compounding stupidity. A state is not entitled to anyone's success. It must earn it, just like a business. If you treat your best customers poorly, they will eventually shop elsewhere. You don't need a PhD in economics to understand that. You just need to be awake. And yet, despite the obviousness of all this, some people insist California is right. They claim the rich should pay their fair share. Well, the rich already pay most of the taxes. That's the part nobody likes to mention. What they mean is the rich should pay more than they already do and also stay here forever, regardless of how badly we treat them. That's not fairness. That's entitlement. If you want the wealthy to remain, you don't need to worship them. Just stop insulting them financially. It's not complicated. Think of it this way. If Nebraska started charging Berkshire shareholders 13% extra for simply attending the annual meeting with no deductions, do you know what would happen? The meeting would move, and Warren would politely explain why. People go where they are valued. Capital goes where it is rewarded. States that forget this tend to end up with disappearing tax bases, deteriorating public services, and a very confused legislature wondering why the math no longer works. And that is exactly what you get when you design tax systems with ideology instead of intelligence. In the end, California's problem isn't taxes, it's hubris. The belief that people will tolerate anything as long as the weather's nice. Weather helps, but it doesn't beat incentives. Nothing beats incentives. If you want a stable tax system, you need something far more important than beautiful coastlines. You need rational policy. And as long as states ignore that, they will continue to drive out the very people who keep them afloat. If there's one thing Warren and I have learned over a combined 150 years of watching human nature, it's this. Good people will do unbelievably stupid things when you give them the wrong incentives. Not evil people. Not criminals, regular, decent people, the type who help neighbors shovel snow and attend their kids' soccer games. But you put them in a system that rewards bad behavior, and suddenly they start acting like second-rate con artists. The U.S. tax system, with its complexity, loopholes, and bizarre rules, practically begs people to cheat. You don't have to teach them. The system itself whispers the instructions. Now, most people think corporate dishonesty is driven by greed. That's true sometimes. But far more often, it's driven by something dumber. The CEO promised Wall Street a number, and everyone beneath him panics trying to hit it. That one bad incentive, never disappoint the forecast, can corrupt an entire organization. Here's what happens. A CEO gets on an earnings call and confidently announces, we'll grow earnings by 12% next year. He says it because the analysts expect him to say something. He doesn't actually know whether 12% is possible. He just knows silence makes him look weak. Then the managers below him hear the number. They know the CEO's ego is on the line, and suddenly the whole organization becomes a factory devoted not to producing value, but to producing that number. If reality doesn't cooperate, and reality rarely does, they start adjusting the edges. Not because they're villains, because they don't want to disappoint the boss. They accelerate revenue. They delay expenses. They overstate reserves. They understate losses. They fill distribution channels with inventory customers didn't ask for and don't want. They massage the numbers until the company looks exactly the way the CEO wants it to look. And here's the punchline. Most of these employees don't make a dime from this misbehavior. They do it because they want to please the guy above them. It's loyalty turned into lunacy. Warren once told a perfect story about this. Decades ago, at one of our insurance companies, a very decent man was in charge of handling claims. Every time he brought a large claim to the CEO would joke that the claim was killing him. No anger, no punishment, just light teasing. The poor man couldn't take it. He started hiding claims in a drawer because he didn't want to disappoint his boss. He wasn't trying to steal. He wasn't trying to manipulate the books for personal gain. He was trying to avoid being the bearer of bad news. That's how fragile humans are. A little pressure, even accidental pressure, and their judgment collapses. Now imagine multiplying that by 10,000 employees across 500 corporations. You start to understand why the corporate world looks like a circus. This is why Warren and I have always designed Berkshire with incentives that reward honesty and punish manipulation. We refuse to set earnings targets. We don't tell managers, hit this number or else. We don't run contests. We don't offer bonuses for short-term performance. We don't give anyone a reason to lie, because once you introduce the wrong incentive, you've started a fire you may not be able to extinguish. And this connects directly to the tax system. The U.S. tax code is so convoluted that it creates endless opportunities and temptations for misreporting. Income can be moved, reclassified, deferred, accelerated, shifted, interpreted. Whole industries of lawyers are built around stretching definitions like taffy. When a system rewards manipulation, manipulation becomes the culture. Once again, this doesn't require bad people. It only requires normal people responding to abnormal incentives. Look at Henry Singleton, one of the smartest business figures of the last century. Absolute genius, chess prodigy, mathematical savant. But even he designed incentive systems so powerful that his subordinates pushed too hard to meet targets, and 3 different divisions ended up in scandals. Not because Singleton wanted misconduct, but because incentives overpowered judgment. That's the danger. People think they make decisions based on ethics. Usually, they make decisions based on pressure, and most people crack long before they realize it. This is why Berkshire avoids systems that encourage short-termism, prediction games, or ego-driven forecasts. And it's why we have no patience for a tax system that essentially trains people to behave badly. Incentives matter more than intelligence, more than education, more than slogans about integrity. Show me the incentive, and I'll show you the behavior. It's one of the great iron laws of human nature. If you want honesty, you must reward honesty. If you want long-term thinking, You must reward long-term thinking. If you want a functional tax system, you must design one that makes truthful reporting the easiest path, not the hardest. Right now, we have a system that encourages the opposite. It punishes transparency. It rewards cleverness. It elevates manipulation. And then people act surprised when companies behave exactly as the system trains them to behave. You don't fix this by giving moral speeches. You fix it by fixing the incentives. Until that happens, the great tragedy of American business will continue. Good people turning into reluctant liars because the system nudges them down that road. They don't want to misbehave, but they will, because systems shape people far more than people shape systems. And a system built on bad incentives can corrupt even the most honest among us. By now, you can see the pattern. The U.S. tax system is not a mathematical error. It's not a technical glitch. It's not a spreadsheet miscalculation waiting for a clever accountant to fix. No, the real flaw is much simpler and much older. The system is broken because people are broken. And I don't say that with cynicism. I say it with experience. Human beings like to think they make rational decisions. They don't. They make emotional decisions and then retrofit the logic afterward. And nowhere is this more obvious than in taxation. Politicians promise lower taxes, higher spending, balanced budgets, and booming prosperity all at the same time. It's mathematically impossible, but politically irresistible. And through this impossible recipe, they create a tax code that looks like it was assembled by a sleep-deprived novelist halfway through a nervous breakdown. Corporate executives behave the same way. They say they want simple, fair tax rules. Then they hire entire armies of lawyers whose only job is to complicate the rules until they no longer apply. These executives aren't villains. They're responding to incentives. And unfortunately, the incentives in the U.S. tax system reward creativity in all the wrong places. Individuals aren't innocent either. Give people a chance to shave a little off their tax bill, and many of them will suddenly discover a flexible relationship with the truth. Tax deductions magically appear. Expenses become business-related. Home offices expand in size by 300%. Dog food becomes a guard animal maintenance expense. People will try anything. This is not because they're wicked. It's because the system practically begs them to try. In a simple tax code, cheating is obvious and difficult. In a complex tax code, cheating becomes a kind of national puzzle that people feel proud for solving. If you design a labyrinth, don't be surprised when people start behaving like rats. And that is the core issue. Every layer of complexity added to the tax system becomes a new playground for human misjudgment. Complexity rewards distortion. Distortion becomes habit. Habit becomes culture. Eventually, the entire system is built on a foundation of cleverness instead of honesty. This is why fixing the tax system is so hard. People treat the symptoms, the excessive rates, the loopholes, the offshore games, but they ignore the disease. Incentives that turn rational people into opportunists. A broken tax system is not a technical problem. It's a behavioral problem. And behavioral problems don't get solved by policy alone. They get solved by designing systems that make the right behavior the easiest behavior. But America hasn't done that. America has done the opposite. The tax code is now so enormous that no one truly understands it, not citizens, not politicians, not even the IRS. When a system becomes too complicated for its own administrators, you know you've crossed into absurdity. Let me give you a rule that has served me well. When a system becomes too complicated to manage, the people inside the system will eventually stop managing it and start gaming it. That's exactly where we are. Politicians game the tax code for votes. Corporations game it for profits. Individuals game it for survival. And the country ends up with a tax system that resembles a circus tent held up by chewing gum and wishful thinking. The irony is that America could easily design a fair, rational, transparent system. The knowledge exists, the math is simple, but the will is absent. Why? Because real reform requires compromise, and compromise requires humility. And humility is treated like a contagious disease in Washington. So instead of improvement, we get patches, patches on patches, special revisions, exemptions, credits, deductions, and then more patches to fix the consequences of the earlier patches. It's like painting over rust. The surface looks better for a moment, but the decay continues underneath. Now, here's the final uncomfortable truth. Even if you created a perfect tax system tomorrow morning, it wouldn't stay perfect. Human nature would ruin it again. Lobbyists would poke holes in it. Politicians would carve favors into it. Corporations would search for angles. Individuals would search for shortcuts. Simplicity decays into complexity because complexity serves someone. That's why systems break. Not because they fail, but because people succeed at bending them. After almost a century of watching this, I've reached a conclusion that isn't cheerful but is accurate. A tax system will always drift toward dysfunction unless the people running it actively resist their own nature. And that's rare, very rare. So what's the solution? Well, it's not perfection. Perfection is a fantasy, but you can aim for something much more realistic. Reduce the opportunities for stupidity. If you limit the incentives to cheat, people will cheat less. If you simplify the rules, people will misunderstand less. If you eliminate loopholes, people will lobby less. If you reward long-term behavior, people will behave long-term. A rational tax system is not about punishing success or engineering equality. It's about designing incentives that encourage productive behavior and discourage the harmful behavior that arises from ego, fear, and short-term thinking. But until America accepts that human nature is the real adversary, the tax code will continue to look like it does now. Bloated, illogical, and constantly gamed by the very people complaining about it. Systems don't fail on their own. People fail them. And unless we become wiser about how we design incentives, we'll keep getting the same result. A tax system that reflects not the best of human nature, but the worst of it. That's the truth. Cold, simple, and completely unavoidable.